Hello and welcome to episode 26 of Great Quarter Guys. I am your host, Andrew Cox. I'm here with the younger, better-looking Mr. Kevin Hill, my co-host. How are we, Kevin?
Doing good today. 26 weeks. Is that 6 months?
That is right. Well, we had this debate a second ago whether this is 6 month the 6 month reunion or not, because we've had 26 episodes. That could be half a year, or 24 weeks could also be 6 months. 4 times 6, 24. I don't know. Doesn't matter. Either way, we got a great show for you today. We are going to run through a couple companies in our earnings season. We've got KnightSwift coming up, as well as Landstar and ODFL, some of the best in the biz. But we can give a little update to last week's long short. We've been doing a little update to the last week's long short. Both of them were really long-term things. We were questioning whether XPO would have another acquisition. That is, of course, in the air. And we questioned whether oil would ever reach $50 a barrel again. That one's, of course, in the air. What is it now? Something in the 20,
I guess they're both
range?
in the air. I think we can both pretty well say that oil is not going to reach $50 a barrel in June, or for the
certainly.
June contract, because I think it's trading around $10 right now. So it is headed south very quickly, and a lot of stories are coming out right now where there's no storage capacity, and that's becoming a narrative. Whether that's absolutely true or not, it's certainly a narrative. And a good one would be, will oil go below zero on May 20th, 21st, whenever that expiration is?
It's likely. I mean, we've seen all of these vessels being used as just open water storage units. I mean, just thousands of them out on the open water right now, just carrying oil because we don't have anywhere to put them on land. Yeah, it's a crazy time for oil.
Ships without destinations.
That's right, just floating along like the Carnival cruise ships a couple months ago. Okay, so back to it. We're at our one good piece, our new segment we started a couple weeks ago, which is my attempt to try to find some good data in this time of absolute terrible data. But I do have some good one for you this week. Last week we talked about the freight volume stabilizing. We thought that may have been the bottom. It seems that it is. There are some positive signs in a lot of the bigger markets in the U.S. that things are beginning to tighten up and get better. So that was last week. This week we have the Bank of America credit and debit card spending. I talked about this on the coronavirus market update this morning, and this is actually a really good sign. We only have the data through the 16th, so 2 weeks ago. We'll have new data from Bank of America at the end of this week, so we'll keep you updated there. But there's a couple takeaways that I think are really good and constructive for freight volumes and the overall economy. The first one is that consumer spending has bottomed in pretty much every category across the board. They break it down into 15 or so categories, and almost every one of them has bottomed and are now improving through the end of 2 weeks ago. And e-commerce was a bright spot. I mean, people are having to buy things online because their favorite stores are closed, but in any case, the e-commerce growth has been significant. It's up over 50% year over year, and if you average out the last 2 weeks that we have data for. A third note was that grocery spending actually begun to pick up. We saw that massive pull forward that caused the freight frenzy, and everything was crazy there at the end of March. And then you saw grocery spending really fall off because people had everything they needed. You're seeing that now pick up again, which is good for everyone. And then the stimulus checks. If you look at when the data hit, when our data changed on the 15th, that was when a lot of people got their stimulus checks for the first time. You see an immediate bounce. You see online electronics jump up over 150% year over year towards the end of the week, and total online spending jumping up incredibly too. So all in all, I think my takeaways are that consumer spending, people really want to be spending some money. Even at least, some people are having to pay the bills, but there are a lot of people out there that are looking to spend money. And I think once we open up this economy on a wider scale, people are going to be spending a lot of money.
I just do. And when you're looking at the Bank of America, and you can go see this at FreightWaves.com on the DHL Supply Chain Pricing Power Index. That's there on the front page on your right. We have this chart in here from last week, and it's an interesting chart, to say the least, right? Where you think that spending has crashed, it has. There's some surprises on here, though. Travel and lodging are near 100% decreases year over year, which, if only 3 or 4% of the same amount of people are flying and no one's traveling, you would certainly expect. Online electronics for the last couple weeks, they were down or a little bit flat. Is that stimulus check?
I think
161%.
The day the stimulus checks hit.
The day the stimulus checks
I got to think
hit,
people went out and bought some Xboxes and TVs and everything else.
Rented some movies, bought some movies on Amazon, things like that. And then home improvement, right? A lot of the discretionary spending is well below last year levels. Food is essential, not discretionary. Yeah. But home improvement was up 23%.
You've seen, we've seen this Michael Vincent here in office, and everybody's painting their houses. Everybody's building something in the backyard. People have a lot of time on their hands.
And if you drive by a Lowe's or Home Depot or a Ace Hardware, those parking lots are completely and utterly full all the time. So everyone's working from home and painting something. Everyone I know has painted at least one room in their house.
Yeah. Another thing is they're doing a lot of work outside, but some of them are doing work inside in the kitchen is something I see here that you look at kitchen appliances or small in-home appliances. Those have gone way up as well, whether they're being panini makers or air fryers. All of my friends have seemingly bought an air fryer in the last couple of weeks. They're trying to learn how to cook. None of you can, but it's fun to watch. There are some things that are moving off the shelves pretty quick.
There is, yeah. Everyone's redoing a room in their house, internal painting as well, or indoor painting. So there's a lot of home improvement, and e-commerce is of course doing well. Everything else, basically clothing, gas is a big surprise too. Down basically 50%, right? That's 47%.
Yeah, is it a surprise? Nobody's really driving?
I haven't filled up in 2 months. So.
Yeah, I was thinking the same thing, and even when I do fill up, my gas price is half of what I would expect it to be, or at where it was last year.
I drive a mile to the office and a mile back, and that's primarily that's been it.
Yeah, I was creating a new budget for myself through the summer, and I was like, okay, gas costs, and I was like, well, they used to be X, but now they're about 50% less than that. So I'm literally filling up once a month, and it costs me $20. Yeah, so it's just. Bad for the oil and gas producers, really good for the consumer.
That is correct. Yeah, the oil market is a crazy market right now.
So let's jump into earnings season.
Let's do it.
We're about past one good piece. I'll bring you another one next week. I'm sure it won't be easy to find, but we will find it.
It's easier and easier to find.
It's getting easier.
It really is.
It is. It's getting better, which is good news. So we've got 3 companies for you today. We've got 2 of the best in the business. We've got one of the best truckload carriers in KnightSwift. We've got a dominant LTL and very efficient player in Old Dominion, and then we'll talk about Landstar as well, so we can get a little bit of that brokerage space. Starting it off with KnightSwift, of course, there are going to be inevitable bad news. The revenue declines are likely for most people. Their EPS was down 20% year over year, but they did beat estimates, all the street estimates and analyst estimates, because they have a strong focus on cost control. And this is really the big point of focus for me when we're talking about KnightSwift, is that they've just continued to prove that they're the best in the business at responding to changing market conditions and ensuring that they're in a good space. They've taken their mix of business and shifted their capacity away from their customers with heavy declines in demand, and to the people that are moving essential goods, grocery and food and consumer staples. Pre-crisis, they were at 61% essential mix, and now they're at 72% essential mix by the end of the quarter.
Yeah, there's one of the things that really struck me whenever we looked back. It was one of our earliest episodes, I think. And so it was 4 or 5 months ago. We looked at the KnightSwift acquisition and integration, how it was going a year plus since the acquisition. And you had Knight that bought Swift. Knight was about a quarter of the revenue size that Swift was, but they're both valued roughly the same, around $3 billion, right? So they're very efficient. They're very strategic. They have a really good management team in place. And to see them do that through this quarter, the first quarter mix shift over to more essential products, or customers with essential products, is something that, in retrospect, it's to be expected. It's not too much of a surprise that they were able to do that. April has been challenging, like it has been for all truckload carriers and LTL carriers, as we'll see in just a second as well.
Yeah, they noted that they were seeing a significant declines towards the last week of March through in the first week of April. They were seeing a double-digit decline in volumes in that first week of April, which makes sense. If you look at our outbound tender volume index, it's also down about 11 or 12% year over year. But more good news for KnightSwift. They actually brought down their OR during the first quarter, down 30 basis points to 86.5. And as you mentioned a minute ago about the differing, or about the same valuations but much different size between Knight and Swift before they merged. merged, or before they became one. Knight is historically the most well-run truckload company. They've historically had low 80s OR, and they still break them down in their reports. They had Knight is currently at 83.5% OR, and Swift is still coming down. When they bought it, I believe it was still in the low 90s, and they've brought it all the way down to 87.6. So again, just continuing to chip off and try to integrate that the Swift part of the business down to the Knight operating levels.
Yeah, and they also said during their earnings call that April was about 11% down in volumes in the first couple weeks of April. So volumes are coming down, and this coming down really across the board, as well as pulling guidance, which I think is what every truckload carrier, every transportation, most logistics companies are basically pulling guidance right now because who knows what's going to be the story for Q2. Well, I think maybe the industrials might come online in Q2. So Q1 was all about consumer essentials, food, toilet paper, of course, right? Yep. Anything that was a panic buy, but I think restarting a lot of the factories and auto plants as well, coming into the middle of May, you're going to see all those supply chains have, a lot of those are just-in-time manufacturing too. And a lot of those inventories probably weren't set for everyone to go home for 3 to 4 weeks or longer, 6 weeks, 7 weeks. So I think you're going to see a lot of chaos in that part of the market, and that's at least going to put a floor under everything else. It might lift it up, and you might see certainly probably not 30% year-over-year volumes like we saw in early March, but you're going to see a lot of volatility coming to outbound tender volumes, and also maybe rejections as well, which would be welcome news, especially for rejections.
Yeah, before we hop back to KnightSwift, I think it's important to talk a little bit about the auto manufacturing plants. We've seen that the big Detroit manufacturers, GM, Chrysler, Ford, they've all been meeting with the state of Michigan for the last couple of weeks now, trying to get a plan in place for when they could reopen, and they actually set a date. They came up with a date for May 18th as their kind of soft reopening, where they have some production being brought back online. And I talked to Anthony about this on FreightWaves Now today. I think that the auto manufacturing sector is really well positioned to kind of make the blueprint for what the wider industrial economy reopening would look like. And I think there's a couple of reasons. One is that I think they're well positioned in Detroit to create a safe environment because of the union. The union influence. I'm hoping that the union bargaining will be able to get safer conditions and all of the protective equipment they need, but also because the way that manufacturing is set up in automotive with the conveyor belts, they're much less densely populated of warehouses than, say, an Amazon fulfillment warehouse or meat producers. Right, exactly. So I'm hoping they can learn from those mistakes of the meat processors and just the inherent variables that make it less infected. I think that they can really do this correctly. Hopefully, can do this correctly and then give the layout to the rest of the country.
And I've been hearing that as well, that they are studying meat processing plants and then other facilities that are open right now, finding out what their mistakes are or were in those, how to social distance. And I think they're collaborating too. And a lot of that has to do with the unionized workforce, right? Because the unions represent workers in all three plants, so the same union does, right? There's more than one union, of course, but they represent employees in multiple employers. So it's really conducive to the auto industry and going forward for them to come up with a plan, and they have great engineers too. Great engineers, so industrial engineers, mechanical engineers. So I think they're going to come up with the best blueprint out there, and hopefully that's the standard for everyone else as well.
One can only hope. I mean, we are an economy of consumers, but also an economy still of manufacturers. Even though it's dwindled down over the last 50 years, we need to get that backbone of the economy up and running. But back to KnightSwift to finish up their Q1. They did pull guidance. They're expecting Q2 to be ugly, as is most everybody. They did have 2 months of pretty normal volumes, operations before that whole freight frenzy at the beginning of March. But KnightSwift continues to operate through the COVID-19 pandemic with a really diverse customer base. Even though that they've shifted away from or shifted towards more essential businesses, they've still got a really diverse customer base, and they're agile. They're really able to move capacity back and forth, which is it positions them to be able to weather the
very
storm.
Well run company, very efficient, and they'll weather the storm very well.
Yeah, as you said, in hindsight, it really shouldn't be surprising that the best run truckload carrier performed pretty well. So
let's move on to the best run LTL carrier.
Yeah, let's do it. So this is Old Dominion, of course. They are historically just a very efficient, tight-run company. Their EPS was actually up year over year. They had EPS up 1% year over year, which was just shy of the street's estimates, but some of those estimates didn't include that they had $10 million in excess bonuses that they paid to workers working through COVID. So that's awesome to hear. The brightest spot for them was, again, just continuing to bring down the operating ratio. They've brought it all the way down to 81.4, lowest in record.
They just keep on bringing it down slowly right now, but surely, and they are. And another thing, and I don't want to skip all around, but they're saying that 2/3 of their operating costs or they deem as variable costs, which is
well, that's really helpful to have when when your revenues drop down 20 or 30%. Your daily revenues drop 20% to be able to have.
I want to have an asset base. Someone with so many terminals and so many assets can have 2/3 of the costs as variable costs.
Well, they might consider some of their workforce to be variable. I don't know if you've seen this. It's hard. It's unfortunate to celebrate them shaving off 15% of the workforce, which is what we're kind of sadly doing here, talking about the operating ratio coming down. But they did lay off 15% of the workforce. They've idled a lot of trucks and a lot of service centers to kind of try to match that decline in demand.
Yeah, and then the volumes down. I think April volumes, right? We're down. So first quarter volumes were down 10%.
Yes.
And then so far in April, and that covers the first couple weeks before they reported last week. The first couple weeks of April were down 25%.
Yeah, revenue down 20%.
Revenue down 25%. Tonnage was up a little bit, though. Right.
Yes, correct. The impact to tonnage has been pretty modest for ODFL. Their weight per shipment was actually up 10% in April. So they're having much fewer shipments but higher weight, again, because they're
and part of that is the exposure to LTL has to small businesses.
Correct.
Right. And the shutdown economic the economic shutdown for small businesses has really hurt LTL across the board.
Just like KnightSwift, management has both said that they expect the bottom to be coming very soon. This is something that we've been battling here back and forth at FreightWaves on where the bottom's going to be, but whether the bottom is 1 day ahead or 2 weeks ahead, this is just a crazy stat to me. The stock is just. It's just crazy expensive. It's unbelievable. It's now trading at all-time high for forward PE ratios. It historically trades around 16.5%. It's now trading at 29%, Kevin. ODFL.
It's insane. You sent me I think it was Bank of America research report. Was it Bank of America? Or earlier today, and we're reading it, and if you look at any of the analysts who cover ODFL, they're all underweight.
Yeah, I mean, they're all great company, underperform.
It's a great company. They're all underweight, underperform. And that's where when those contradictions with stocks versus the company come in, they're valued probably too high because they're such a good company that they're overvalued. Yeah, which is not a bad thing for a company to be overvalued. But as an investor, you're paying a lot for a great name, and you want that price to come down. You want to buy it and sell, right?
Yeah, there's only a couple instances of truly a management premium that you get on a company in the transportation sector. A lot of these companies are valued very close to each other, but KnightSwift is one, and ODFL is definitely another, where they get a very serious premium because of how well their company runs and how much investors trust their management.
And they both get those. You're exactly right. They both get those great premiums, and then that's the reason why everyone's underweight ODFL.
I mean, they're
because they're such a great company, and everyone wants to own them.
Yeah, and honestly, in the LTL space, there's not that many pure play players that you can go out. There's SAIA. There's a handful of others there that are not Messiah, that are not. They're just not that big of companies. There's only 4 or 5 that we track in our weekly LTL index. So there's just not many there. That's why they get that premium.
Yeah.
So next to a brokerage, we're going to talk about Landstar a little bit. We wanted to get a little bit of the asset light space into our earnings coverage, and
Landstar is one of those that have the unique business model, right? So you have probably the best truckload operator, the best LTL operator, and then you have Landstar that's unique because they have BCOs.
Yes, the business capacity owners.
Business capacity owners, which are those owner operators that lease on to Landstar, so they're asset light. They don't actually own the trucks, so they're leased on, and by far the largest business model like that. And I think the only public company that really concentrates on
the agent model with
the agent model for the sales, where it was commission only.
Well, yeah, they had EPS of 110 per share of $1.10. This is again massively down from last year. It was at $1.58 in Q1 2019. So again, brokerage revenues are down considerably. If we break down into the different segments a little bit, total revenue was down 10% year over year. Dry van was down the most. It was down 12% year over year, and that was mostly from loads. They lost a little bit. Revenue per load was down, but loads volumes were down 7% there. So that takes the cake. Flatbed volumes were down 8%, or flatbed revenue, was down 8%. And LTL held up a little better. It was only down 2%, while loads were up considerably, up 9%.
Though they were, and the flatbed numbers only being down 9% is kind of bullish a little bit. If you look at what happened to oil,
to how bad
what happened to auto,
and manufacturing and industrial, it's pretty encouraging to see that they were able 9%. To increase loads.
And I've been hearing that from my friends who move a lot of flatbed stuff. That is the market's really not as bad as what I would have expected, which is good.
Yeah, it's definitely good. And they actually expanded gross margin. They were able to grow at 30 basis points, up to 15.4%. I haven't run numbers recently on industry averages right now, but I'd say during this, that's a pretty strong number, 15%.
It is. It's a very strong number.
I remember we were talking about JB Hunt last week, that it fell to, I believe, low teens, 11 or 12, right?
It did, yeah. It was high single digits, like 9.1, 9.2%.
So so they expanded gross margin. That is great, but the bad news: April volumes down 20 to 30% so far in April.
And then that was from the call, right?
Yep.
And whenever management says, our load volumes are down 20 to 30% in April, that's pretty serious.
Not good. I mean, this is compared to minus 14% the last week of March. So a significant increase in the decline of volumes, and then only negative 5% for the majority of Q1. So
and
things
what
are
was KnightSwift on in April? Did they have a number? I can't remember if they had a number of like a true volume number.
Yes, they're seeing April volumes down in the high single digits.
High single digits, okay. Yeah. And they're more concentrated in the food.
Yes, they've been able to pivot away from pivot towards more essential stuff.
Which Amazon has a lot of essential. I don't know what exactly the mix is, but I know that they do a lot of your normal manufacturing, discretionary type of business. So being down 20 to 30% is rough for any business.
And again, that's one of the reasons that they pulled guidance, as did the other two companies we've spoken about. They've management said on the call that they thought pricing has actually held up pretty well so far this year. But again, one of the reasons for pulling guidance is because they expected that to change very quickly.
True, and there'll be big winners if the industrial economy. I keep on going back to auto because it's very recognizable. It's easy to talk about, but you have a lot of steel, oil, and gas and things like that. Mm-hmm. But auto, other industrials like that, if basically those do come back, that second half, like late May, June, see some sign or any sign of reawakening, which it sounds like they probably will, that should be very bullish for second quarter.
Yeah, I mean
maybe the opposite of the first quarter, right, where everything was basically in line until March, mm-hmm. and then everything shot up. But starting out in April, everything is sliding 10%, 20% down. The quarter might be saved with the second half.
Yeah, I mean, it might happen, speaking for the carriers, it might happen at a good time where they get a lot of influx of produce coming in mm-hmm. that late May, early June. There might be some other factors there, increased drink consumption that we typically have in the summer. There mm-hmm. are some things that could be in play, just that normal summer peak that happens as the industrial economy gets back on the way.
So the industrial economy, I think it's going to be very volatile just because everything is really just in time. It needs to be produced. And when steel needs to go from A to B, and coming from someone who has shut down an auto plant because the truck didn't arrive, everything's pretty expedited at that point.
Well, listen, I told Anthony the other day is that people think of, the manufacturing economy, but specifically, the industrial manufacturing economy as this conveyor belt that can just be turned on and off. But it's more like a ballet, man. There's a lot of delicate balancing parts.
And if you look at the auto industry, I mean, Canada's been shut down. Mexico's been shut down. Right. A lot of those parts that feed in and feed back out go to those two countries as well. So it's really a North America thing. and that ballet is, or that music, or the steps are completely out of whack right now.
Yeah.
The rhythm, that's it. The rhythm is
something you're lacking.
Yeah, it's something I very much lack, yes.
All right, well, let's get back in rhythm here with the DHL Supply Chain Pricing Power Index. We've moved on from our earnings season update. We're down another 10 points this week. A little update. 0 would be all the power to the shippers. 100, all the power to the carriers. We've now fallen all the way to 15. This is tied for the lowest point of the series history. We've been doing this since September. And our reasons for doing this is, volumes are still depressed. They are seeming to find a bottom, that we may actually see that volumes are up week over week this time next week. But rejection rates are just in the tank. They're under 3% now.
They are. They keep on sliding.
I mean,
I
every
think
day.
we're only about 1% below last Wednesday.
Yeah, I think
or
we're
last
at
Tuesday.
2.64% or something. I think that's the date today.
Yeah, so I think by Thursday we might have a positive week.
It's true.
Week over week under a belt, so we can maybe move it up a little bit. But yeah, the rejections.
I mean, monitoring how those rejection rates are going to move as the volumes start to pick up is going to be really important for me to see if any of those drivers that parked their trucks have kept them parked. Are we going to, we already had overcapacity issues prior to COVID-19, prior to there being Christmas Day volumes for a couple of weeks. So is this environment, is this COVID lack of volume going to push anybody out of the market? Are they going to stay out of the market? That's something we're going to have to monitor.
We do the coronavirus freight market update. We did it earlier today, every Tuesday and Thursday. And especially on those shows and with the truck, too, I think they get a lot of comments about drivers who, they call in, type in, saying that they've parked their truck.
Yeah.
They've been parked for 2 weeks or 3 weeks just because of the spot rates. And then you have this whole discussion in the freight world about spot rates and freight brokers just gouging and kind of that battle between trucks and brokers, and that's really heated, and it's been heated for the last couple weeks. So, and it's all tied that 2.69, 2.61% rejection rate, which is you can't really fall too much lower.
It seems to be the natural.
Once you get there,
gotta be the natural
there's
floor.
probably not much of a difference between 2.5% and 0%. Right?
Not at all. No, I agree with you. Let's go ahead and go to our long short. We're on that truncated time frame today. We're going to be in and out in 30 minutes, so we'll get through this long short real quick. A company that I've been pretty excited for, that has been trying to go public for a couple years now. They finally did it through a blank check, kind of a non-normal route to public markets. But this was DraftKings. This is, of course, they started as the daily fantasy company back in 2012, where they would play daily games. Started with football. They've now expanded to not only have daily fantasy, but they've got online sports gambling and online casino gambling. So that's pretty much their three money makers. Kevin, are you long or are you short the idea of DraftKings becoming the household name for online sports gambling?
So, how did they merge? Or no, they didn't merge. How did they go public?
So
Was it reverse?
It's basically like a SPAC. Yeah,
A SPAC, okay.
Yeah, it's basically a special acquisition vehicle. They merged with a company that was already public in 2019 for $10 a share. They traded up 10% on their opening day of trading. I think was yesterday or Friday. I can't remember, Friday or Monday. Traded up 10%. They've fallen back down now. But what do you think? Are you long or short them being the household name?
I remember maybe they had one advertisement out.
Yeah, they had
they had like 5 advertisements.
I
mean, it was like every single commercial.
You're watching a football crew every game.
Kings.
Yeah.
Or
FanDuel,
whoever.
or the FanDuel was the other one. Yeah.
FanDuel.
They tried to merge and they didn't allow it.
That's exactly right, because they had cornered the sports
the only two.
/ fantasy football market.
Yeah.
You know what? I think I'm short because I don't think online gambling's here yet.
Okay.
And I think like Barstool Sports will give them a run for the money, right?
Yep.
I think they're
Penn
very
National.
well positioned to capitalize on national online sports betting, and so I don't think so. I think their real day in the sun came and went when they're advertising. Whenever they got barred from advertising, I think it was that they got barred from advertising on TV.
I think they did. They overdid it a bit. I'm actually short as well. Not because I'm very long the idea of online sports gambling. I think, but I just think there's going to be a lot of different players. I don't think there's any one player that's going to emerge as the dominant the dominant position. I think Penn National with Barstool Sports will be good. I think every MGM Grand and every normal sports gambling place, they're going to have their own online books. It'll be a very diverse and
I mean, there wasn't
open
anything
market.
that really differentiated DraftKings or FanDuel at all. It was all a marketing play, and that marketing play is not gonna, they're never going to be able to outspend everybody else like they did when they first started and they were original.
Yeah.
You know, because it wasn't betting, it was fantasy football, and
everything changed in
they saturated
2018 when the federal law changed to allow states to decide about online gambling, which was good for them. But now they just have to pretty much they have to lobby with each and every state to get these things passed, which is not cheap.
That is not cheap, and probably they're not in the best position. I think MGM Grand and places like
the legacy
Hard
players.
Rock, even Hard Rock that operates in many different states. WinStar, they're in probably just as good, if not better, position as
another terrible point I wanted to say.
DraftKings.
The CEO retains 90% of the voting rights on the stock.
Yeah, so I'm definitely short that.
That
is really not a good situation.
Yeah, no bueno there. Okay, another long short. This one will be a little bit more fun. We have had a lot of news, and let's hope that there's an NFL season. We'll talk a little bit about this one. Let's go long or short. The Tampa Bay Buccaneers with their new quarterback and Rob Gronkowski coming out of retirement. They're expecting 9 wins in Vegas. Kevin Hill, you over or under 9 wins?
We're short on time, so I'm going to go over if they play a game.
Yep, I agree.
I think they'll get 10. What about you?
I agree. I think they're over. They drafted Keyshawn Vaughn out of Vanderbilt, so I'm now a Bucs fan. So I'm over on the Bucs. We'll give the quick plugs. Next week we are live, FreightWaves Live at home with Ben Gordon, the founder of Cambridge Capital, a prominent PE firm here in the transportation sector. So we'll have him on for a long discussion, and we got a bunch of stuff coming up this week. Coronavirus, What the Truck, Put That Coffee Down coming on tomorrow. What are you guys talking about?
We're not talking about side hustling, doing your own business, putting in time to learn new skills.
All right, so perfect for you and Dooner. Talking about side hustles, make sure to tune in tomorrow. This has been episode 26. We're on a 6-day, 23-hour break. See you next week.